All right. Here we go. What is up, everybody? Hey, this is John. I am back. So we're going to cover some deep dive and deep value dividend stocks today. So the market today has rallied quite a bit after the Fed did their recent cut the other day. So stocks have went up, and basically as interest rates drop and they continue to drop, dividend stocks and dividend growth stocks are probably going to continue to rise because it's going to push investors and a lot of money into those types of investment tools and away from safe instruments like money markets and treasuries and whatnot, because now their interest-free risk is a lot lower. So having said that, let's dive right into it. So an update from the last video. I want to try to get more consistent with these. This is actually not a direct reflection. So I made a large sell today, and I also made multiple buys we'll cover. So now the value is actually more like about 222,000, and the profit. So as you can see, the portfolio is really not up hardly much at all. The majority of this money is money implanted for me, and you'll see here in a moment why that is. I'm also battling a bad cold, so if you guys hear me cough or heck, you know why. This is live, so it's real time. This is real life. So just pray for me. Trying to get better there. Just excited to share some stuff. So that being said, you buy assets that are trading at a discount and that are low. So that's why my return is terrible right now. So the majority, if not all of my holdings for the most part, are on either deep value or pretty fair, decent value. You'll see that. So the income is now over $10,000 annually and growing. The dividend growth rate on this portfolio has been averaged about 11%, which is phenomenal. So now we'll look here, some metrics. So as you can see, about 12 years out from reaching that fire movement projection, 100,000 adjusted for inflation, and assuming a 1% greater inflation than historical past as well, seeing how we've seen all the money printing in recent times. So I kind of want to just go to the holdings. I'm going to show a breakdown of what I sold. So I sold off the Hershey's company, sold them at a slight gain. So my total value on that was about right, just over 16.5, and so I made just around a thousand on them. Now, granted, I made dividends over the course of this time. I've held them for a year and a half, 2 years now. I just saw, because of commodity prices and everything else, I think they'll be fine long term, probably. It's an interesting play. However, I saw greater opportunities in the other holdings. And so when you see that, you got to reallocate, because time is money. So that being said, what I did buy, just off the cuff here, kind of going through telling you guys off of all these holdings listed here. So I bought a couple grand of Visa, about a couple grand of MasterCard. I brought, with those proceeds, I also bought 3 grand of Wes. That's a newer holding that I added. And then I also bought just under a grand of Procter & Gamble. They're down pretty decent too. And then I bought about a grand of General Mills. I bought 3 grand of a new position that doesn't show here yet, Flowers Company. So they do Dave's Killer Bread, and they're down a huge amount, and they're over 9% qualified dividend. I think that yield is fairly sustainable currently, even though they have a high payout ratio. That's an interesting one. Comment below if you're interested in hearing more about them. I can do a deep dive on them, on any of these really. And then I bought a tranche of some more IIPR. Where is that one at? Let's see. I guess maybe it'll show up here or not. Right there. So anyways, I bought another grand of them. And then I bought 3 grand of Zoetis. I bought another little tranche of United Healthcare. And what else? Excuse me. Yeah, I think I'm missing one or two. But anyways, all the ones that I did buy today are down, generally considered. However, some of them are not. But let's kind of go to the portfolio lab, and you guys can kind of see here, find the dip. And I don't use this by any means in conjunction solely. So I always tell people, do your own research. I'm a big proponent of that, and find out what you actually want to invest in, and then figure out the companies that you want to hold, and just keep a quarterly or an annual update on them, basically. As a long-term investor, that's necessary. So basically, Zoetis, goes based off of a 200-day average, finding what's been traded at the lowest of their 52-week low, basically, of the holdings that you hold in your portfolio. So Zoetis is listed as it's down a lot, although I want to caveat that with Novo is down a huge amount. Over the last year, they're down over 50%. Zoetis is down a good chunk too. These are both in super good buy ranges. BTCI is down a good tranche. That's something I hold as more speculative, pegged to Bitcoin for income. And I would never allow it to go more than 2-3% of your total portfolio value, if that even. And then General Mills, that's down close to 50%, 40% from its high. Excuse me. And Flowers Company, from its high of $20 some a share just over a year ago to now it's like $10 and change a share. Like I said, that starting dividend yield of over 9%, ticker symbol is FLO. That one's down a lot. Kroger a little bit. Hess, United. I don't think this does enough representation of it. If we go out over a year, United is down actually like 40-some percent from its high, almost 50%. So that's why I don't like this on Snowball. It doesn't go out any further than the 200-day average. So, because if I actually go through the holdings, let's just do it real quick. I can tell you some value. So SCHD, even though it's hated on a lot because it's underperformed the market within the last 3 to 5 years, it's doing exactly what it's supposed to. Professor G and a few others commented on it. I'll make my own assumptions and comments. And basically, the market has rallied very bullish because of the AI. But if you actually boil it down and look at the top 10 companies of the S&P in the market, or what is propping up the other 490, let's just call it, S&P 500 is actually a little more than 500. So it's even greater than that. But the majority of those companies underneath those have actually underperformed or are flat. So it's a sign of kind of where we are macroeconomically. So you can't just look at it in isolation. And so SHD holds real companies at the NASDAQ 100. And therefore, it, is a real representation of real businesses. So real businesses and a real economy feel certain financial pressures and pains and inflation and everything. So they're not the high-flying AI. But when people say that this time is different and that's not going to happen again, that's when my red flag goes up. Because I'm like, well, that's the famous word spoken of every last crash in history. And, when your grandma's talking about the next big stock, I don't have a grandma anymore. They're all passed away. But, I hear stuff like this all the time and read comments. It's like, that's when you should tread lightly and know what you're invested in, rather than just jumping into something just because somebody said on the internet. So that's why I'm a big proponent. Always do your own research. This is just for entertainment. I have the disclaimer. But for me personally, I am never going to tell somebody to invest in something that I'm not investing in myself. So I put my money exactly where my mouth is, right or wrong. And like I said, I'm not a professional, and I'm also not somebody that is a guru. But I can tell you I've had several years now of experience of just learning finances, investing, being smart with my money. And I've made terrible decisions too in those past years. Bad business decision that cost me over $20,000. That was kind of a Ponzi scheme, got sucked into. And I've invested in stupid meme coins and shit. And so I've made plethora of mistakes, but I'm also here to be able to provide a encouragement for those that have also done the same. And maybe you're out there and you're thinking, hey, is investing really even worth it anymore? I'm here to tell you it is. And you just have to be on the right road to success. So success is not a get rich easy scheme. It's not a quick fix. That's for something that you make it down with your car with a quick fix. You make it down the street and you break down again. I'm here to provide you with something that, you know, provides you with a 100,000-mile journey. So this is a marathon. It's not a race. So having said that, going through all these holdings, Novo's down a lot. That's a super good, interesting one. Any of these I can cover analysis on them if you guys would like. Just comment below. And I know I'm restarting things, so the views and everything are going to be quite less than spectacular, but I just want to I enjoy doing this, though, I guess is what I'm saying. So you have to excuse my sickness, but hopefully I get better soon. But that being said, I just like doing this and helping people. So regardless of where it goes, hopefully it sees as many people that it can help as possible, though. So United is down a lot. MPLX is not down a lot. However, it's got a really juicy starting dividend yield, and management is even pledged to about a 12% dividend raise for the next few years, and they just did for their latest at 12%. So you have high yield with high growth. That's an interesting play. For the energy sector, Hershey's I got rid of. It's not a bad company, though. This just fluctuates a lot with the commodity price of cocoa, even though they've made other acquisitions with the Dots pretzels and whatnot. You have IIPR down a lot, and it's up like 8% just on the Fed dropping rates, a 0.25 basis point. That's crazy. That shows you the power of what that does when they drop that. So that's an interesting play in the cannabis sector, a long term. It's partly speculative, though, but they have good financials, even with the tenant problems they've had. Zoetis is down immensely. It's now actually what I'd consider good value. It was trading in the high 20s to 30 some PE for the longest time. It's finally come down to earth, and it's around 18 or so for PE, which is great. And they have really high growth, and they're in the animal healthcare sector. And then you have Hess. Hess is an interesting play. Found them actually from dividend data. Did my own research and homework on them. Found it interesting. The only thing is in that Permian Basin and the area that they operate in. And sometimes I get the names of those mixed up, but it's an interesting play. It's primarily driven in natural gas, and Chevron recently acquired Hess. However, I'm going to limit my exposure to them just because, guidance is good for the next couple of years, but after that, we don't really know. And so I probably won't buy any more of them, though, but I'll just hold my position strong. And then BTCI I'm not buying any more of. That's more speculative into Bitcoin. Here's a penny stock speculation. It's up quite a bit from when I bought it, but it's come down. In the graphene sector, pretty interesting there. Texas Instruments is becoming more fairly valued. However, it's still a little expensive for its past few-year growth, but they're now bringing their new facilities online, so they'll have a lot more growth here in the next few years, I'm sure. And their costs are cut by like 0.25% or 0.25 as well, so that's huge. 25% off of a full their operations and better product, the next gen wafers. And Canadian National is down a lot. Waste Management is not down a lot. However, it's a 25 point something forward PE. This company's always traded rich, but it's not going anywhere. It's waste. And they acquired a medical waste company too, which is pretty neat. So they have that over their next competitor as well, which I can't think of the name right now. Republic, that's it. And then Reality Realty Income. Oh, that's an interesting play. He said these have been beaten down because of interest rates over the last 3 to 5 years. Pepsi, I don't think it's a high-flying, crazy performer. However, it's an interesting play just because of their brands. They're very, very strong, from water to the energy drinks to the pop and soda. I mean, it's amazing just how much filtered water and purified the H2O, which is only going to grow because clean water is a necessity. I was amazed by the brands they own besides just Aquafina. And then Kroger, it's always an interesting play. It's groceries, not going anywhere. JP Morgan, I'm not adding any more to it. It's pretty much near a high. And if we see a recession or a crash, usually financials take the biggest hit besides tech. I said MasterCard is pretty resilient. Same with Visa. During the recession, the market fell like 50-some%. They only fell like 12. So it's pretty resistant, or resilient rather. Every time people swipe their card, they make a fee. General Mills is down a lot. Toro, I like also General Mills because the dog food that, she has a dog, and he eats the Blue Buffalo. But Toro, they're in the landscaping. They're down a lot. They've acquired a lot of different brands of mowers over the last several years. So pretty diversified. And then also they own Ditch Witch, which is huge for utilities. And then Nextra Energy is kind of pledged for the next few years, probably a 10% dividend raise. So that's kind of interesting. And they're in the energy sector with utilities. And then also Google has worked and pledged with them as well for a nuke plant that they're working to get online. Another form of energy, though. Procter & Gamble's down because of consumer spending on name brand items going to store brand. I think that's maybe in the short term going to hurt them, but in the long term probably be fine. Everybody needs toilet paper and soap and household items and beauty products. They own a lot. Elevance Health, that's just almost as interesting as United. I just never went deep into them. I like United, even though I don't necessarily like how the company runs and how it's been. I don't necessarily think there's fraud per se. I think it's more so comes down to the company trying to avoid coverages. And I think a lot of insurance companies are guilty of this. I think probably all of them are, really. And I don't agree with it. I don't think it's right. However, it's just the way of the world. And so, you got to, at a certain point, you accept it for the reality that it is. Just, don't agree with it. But if I had to agree with every single investment I made morally, I probably wouldn't invest at all. And McDonald's, Bill Gates recently bought some of them in their foundation fund. It's historically performed at or above the market around 11% with the dividends invested. However, we'll see how it performs long term. Wes, that's a newer acquisition. Energy, and then Visa, of course. So, and then Flowers, FLO that I added. So there's a lot of good companies here. As you can see, the weighting is all over the place. So it's still working itself out over time. Warren Buffett and Charlie Munger said, if you really have conviction in a company, diversifying is just a joke. And it didn't say that, they didn't use the word joke, but it's BS. It's not actually diversifying. It could be diversifying. So that's why it's good to focus in on quality. So, having said that, take you to some analytics. Like I said, this is not fully updated. So this is to show you the reality. The reality is you can start today. I don't care where you're at. You could have debt and you just need to do the snowball approach and pay it off. But start setting aside $25 a week to invest. And I'm not even saying like a VU fund, S&P anymore, because they are like made up like 40% of it, an insane amount almost the majority, greater than 50%, is, skewed toward the top 7, which is insane to me. So you have the NVIDIA that's way overvalued. I may get hates for that, but it's true. And, a lot of the other Max 7. I owned Google for a while before they even shot up. And some people could be like, well, you should have held them. Yes. But I think now it's becoming richly valued. And then, so out of the Max 7, Meta is probably the only one. It trades at a forward P, I think, around 21 right now. The last time I looked a week ago. That's probably the only one that actually has decent value. The rest are way overvalued. So having said that, profit margins and everything else do not always go to the sky. Eventually, they normalize and come down. And if you have money recirculating between these companies and it's not changing hands with the other 400 and something, then is it really that great of an economy? Ask yourself that. So that being said, I like to own real businesses that have real moats and provide real services and products to people. So that's why you'll notice, even for being young, I skew towards stability. And I'm not investing in bonds and things like that because that's pointless, especially for my age group. But if you're older and you need stability, that's not a bad idea. But having said that, SCHD will make its comeback. I mean, we can go through the numbers on all these and just off the cuff, but SCHD is historically, since inception, about 12% with dividends reinvested, even with being down for the last 3 to 5 years or kind of stagnant, since 2011. Novo, historically, and even with the dip over the last umpteen decades, his 20 years rather, when I was plugging these into Google and asking AI, about a 16% annualized return. In PLX, about a 14% return. IPR, well, I mean, just the dividend alone now, you're at over 13%, the dividend starting yield. So if you even get a 2% growth on that, you're already above market return, even just in the dividend, without even any return. Hess is kind of interesting. Couldn't tell you what it is. Hershey's has been about 10%. United has been like 13 to 16%, somewhere in there. And a lot of these projections for United and Novo in particular, if they make a decent recovery, like, for example, just a normal recovery, United, it'll be projections of 11 to 13% easily until 2030 and even beyond to 2035. If they make a solid recovery, they could be anywhere from a 16 to 20% annualized return. And the same is true with Novo. And then Zoetis, that's long-term animal health. And that sector, still growing at a steady rate. Their returns will be high single to lower double digits. EPS in the mid-single digit range. And then Canadian National's interesting play. Not a high growth one, but it's stability. And then just going through some of these, right? It's like what I'm seeing and what I have off the cuff from my research. But I guess what I'm trying to say, a lot of words, is that everybody can do this, regardless of your situation. I've been striving for this for, a couple years now, actually. I've only been at it a few years now. I just happen to, have a decent income, although I get hammered on taxes. But I worked a lot of overtime. I worked my ass off. And I just was smart with my money. I don't go to Starbucks every day. I don't waste money on stupid, lavish things. And, I'm not here to insult anybody either, though. So I've made stupid mistakes, and I'm going to fully admit it. And I'll probably make more mistakes, but I'm trying to avoid them. But what I'm trying to say is you got to prioritize your life. And if you can start today, just start with a little bit of money, $5, $25. Do that every single week. Mondays and Fridays are, on average, the most volatile days in the stock market. Buy a fund like SCHD, because SCHD, if something's been flat or not performing as well other than the dividend for the last 3 to 5 years, it's actually not a bad thing. It's actually that, hey, the quality is increasing. They're raising the dividends, but you're still buying it at a kind of flat price. You're actually now getting a better valuation versus buying something like the VU that's way overpriced because of the Max 7. So historically, they'd say buy VU and forget it. But personally, I think it's way overvalued right now because of the Max 7. And I think it has a lot of room to fall potentially this upcoming year. We'll see, though. I could be completely wrong. But I like the stability of SCHD and almost a 4% starting dividend with good growth on that. So if you had to just start today, start with a fund like SCHD. Put a little money into it and keep it consistent. And then from there, find out what individual companies you want to hold and then grow from there. And, people say they don't have enough time, but if you really boil it down, I'm busy as heck with my training and everything else that I got to do. And I still find time for this, a relationship and everything. It's what you put priorities on. So prioritize things and always prioritize your health as I'm coughing. But there's something bad going around. So anyways, that's all I wanted to say. You guys have an awesome day. And till next time, take care.